Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, Ryan Bolton here with Patriot Home Mortgage. I am a mortgage nerd. You can check me out on all the Facebook and social media platforms at Mortgage N3rd, Mortgage Nerd. So it's a little play on words. The nerd is spelled with a 3 instead of the letter E, just in the mortgage though, not in the, or just in the nerd part, not in the mortgage part. So again, Mortgage N3rd. This podcast is also a video on my YouTube channel. I try to post some fun little videos on there once in a while, have some fun reels and shorts and all that fun stuff. And it's been really interesting trying to engage with people in this way and kind of put myself out there, learning new skills. So I thought it'd be kind of fun today. I've got my producer here. We call him Freddie Max, as I like to call him. I thought it would be pretty fun to just have him find random questions on the internet and see if we can stump me. I don't know what these questions are. I don't even know if they're all mortgage. I don't know. Freddie Mac, he's into some cool stuff. So
I wouldn't say cool. Maybe questionable, HR related possibly sometimes.
There you go. So we're going to try to stay in the mortgage real estate kind of world. But I thought let's just see, stump the mortgage guy, stump the mortgage nerd. I thought it'd be just kind of fun to just throw it out there and just keep me on my toes and just see what kind of questions he can find. So I think he's got a couple loaded up here. So we'll just see how this goes and hit me with the first one. What do you got?
My landlord quit paying her mortgage and now the house is being foreclosed on. What can I do?
Oh, that's a horrible situation because a lot of times the renter is paying the landlord. The landlord's just not paying the mortgage. Unfortunately, the mortgage company is taking back the collateral, which is the house. Now, a lot of times there's advocacy groups that are out there. There are ways to be able to kind of get even cash for keys is out there where basically the lender will say, okay, we'll give you keys, get you out of your lease because you still have a legal agreement to be able to rent that space from them. So a lot of times the lender actually has to honor that lease in some states. So it definitely gets really sticky. But unfortunately, that has happened. That's something where you pay your rent, the guy's not paying his mortgage, and the mortgage company goes through foreclosure. Once the notice of default is filed, there's 90 days before the lender actually goes into foreclose. So it is still a time period there before you'd have to move out. But unfortunately, the collateral is the loan or is the property, and they still can take that collateral back even if you're leasing the property. But I'd say between you and me, don't be making your payment anymore because he's not making the mortgage payment, or see sometimes if you can work with the lender to take over the loan. So sometimes those loans are assumable. Other times you might be able to refinance or buy the property at the price of that mortgage. So if you're in that situation, call a mortgage expert, see what you can do about getting some financing to basically buy that home. But eventually the mortgage company is going to take back the property. If he hasn't made the payment, that's the collateral. They're going to take back the property. So that's a good first question. What else you got?
When a house is sold for taxes, who pays the mortgage?
When the house is sold for taxes. So what I think this means is taxes can be a lien against the property. They're actually before any liens. So if they haven't paid the property taxes or they owe the IRS, the lien or that debt can take back that asset ahead of the mortgage. So if the mortgage company's out their money, they're going to try to still come after that person for the loss of that particular money. I would also say it's very rare that it gets that far down the process where the taxes are the thing foreclosing on the property. Because usually if they're not paying the taxes, they're not paying the mortgage either. And usually the mortgage will foreclose before the taxes. I think in Utah, I've seen it 5 and 6 years worth of taxes before they start filing for the notices and trying to sell the property. But it is something where if that lien, whether it's taxes on the property itself, whether it's the IRS, state, even HOA, ORS, there's these other types of government liens that can jump ahead of a first mortgage. They will then end up taking the property, selling it, and paying back the debt. Anybody that's in a lien position behind that is out their money. That's part of the risk of lending mortgages. That's why the interest rates are also to offset that situation. But it is something where who pays the mortgage? It's still owed by the borrower, just the collateral might be gone now. So that's where you usually see a bankruptcy or something to stop it even further. But who pays the mortgage is still the person that signed the loan.
All right, this one looks like a ex-husband or ex-wife who's upset.
Oh, okay. This happens a lot too.
Can you go to court to have someone taken off a mortgage and not owe them the share of the property if they have not helped with the mortgage payments in years?
Oh, that's an interesting question. Okay. So the loan was given based on who the qualifications at the time of the loan. So if a husband and wife are both on the loan, they're both obligated on the loan. Just because one person's making the payment and the other person isn't doesn't mean that the loan isn't still owed by both the people. So it's an interesting question here. It basically says that do they still have to pay their share of the asset or the equity? That's a little different than the loan itself, right? Because you got the mortgage against the property, then you have the equity or the split in a divorce. Usually in a divorce situation, somebody gets awarded the house, they have to pay off the mortgage that's in the spouse's name. Divorces are really a crazy part when you're tying into real estate. But it isn't something where all of a sudden you get out of the mortgage and get the property, because the mortgage and the property are kind of tied together. They're part of the collateral. So when you're going through a divorce situation, in most cases, you have to refinance one of the spouses off the loan to clear them off the loan. Now, they can still be taken off the title. They don't have to own the property anymore or have the rights to the property gone, but it doesn't mean the mortgage goes with it. The loan was approved prior to the divorce. It was approved based on the income, assets, credit scores at the time of the loan. So if you're trying to remove somebody for, say, debt ratio, I mean, this happens a lot in divorce situations where the husband gets awarded the house, the wife wants to buy another house, but the mortgage keeps showing up on her credit. And she can say, well, I was awarded my equity or whatever, and I need to get out of the home. It is something where refinance is the most common way to get that cured. The court just can't force the lender in most cases. I mean, there's some cases, I'm sure there's precedent out there where they have done that, but in most cases, to remove a lien prior to the divorce that obviously was dated before that on the title history, a refinance is required. And if the wife can't qualify because she doesn't have a job or only has alimony or child support to qualify for the loan, it may be a long time before that loan actually gets cleared off each person's credit report. So the short answer to that, refinance is the most common situation there. So if you are going through a divorce in Utah and Nevada, you do have a property involved, I'd love to talk to you about it. I can help either with buying the property or getting it to investors to buy it and just kind of cash both of you out of the property, or we can look at doing a loan for whoever is awarded the house. In a lot of cases, one of the spouses is awarded equity as part of the divorce. And so you have to do a cash out refi to pull that equity out to pay off a spouse. So I do a lot of those types of loans. They're sticky. Every one of them's got different nuances with them, but that's most likely the best game plan is just do a refinance. Now, if you have a 3% interest rate and rates are higher, that's just the nature of trying to do it. But generally, people want to keep the house because they still have more equity in it than just selling it and trying to buy a new house at a higher price and a higher interest rate. So we do see a lot of refinances in that divorce situation. So hope that makes sense.
All right, next one. I plan on retiring next year, and I'll have the funds to pay off my house. Is it best to pay it off or to keep paying the mortgage?
Keep paying the mortgage. I know that seems weird because as soon as you retire, you say, I don't want a house payment anymore. Here's how I look at it. You have $100,000 in the bank or a $100,000 loan. You can make the payment with the money that's there and still have access to the money. You can have a better rate of return on the money sitting in an account right now than paying off the mortgage loan. So I think cash flow, having access to the money, is safer than having access to equity you can't get to without selling or refinancing the home. So I feel it's better to have the money in the bank. It's under your control. You're earning a rate on that. You can pay off all the other debts. Usually your payment on the mortgage is going to be cheaper than other types of debts. And I just look at if you're at that retirement age, maybe your income's going down. Maybe getting access to a new loan is going to be harder in the future. And having money in the bank is way more safe if you're looking at retirement. Now, you may have something where it's a 401 pension where you have to do a certain amount of withdrawal or you lose it or you have to pay taxes on it. So it does make sense that maybe there's time to pay down the loan. But I really think cash is king. And I ask you, would you rather have $200,000 in equity you can't get to without selling or refinancing, or $200,000 in the bank that you can use to make the payment each month? You can put that $200,000 in an account, have it make the $1,500 payment, and how long will it last before it runs out? They're going to get the money either way. Why not spread it out over the next 10, 15 years, however long you've got left, and be able to enjoy the interest returns on it, the security, the safety? I think it's better to have the money in the bank. But every situation is going to be different.
You're saving money on writing checks, though.
Yes.
You write one check instead of another 12 years of checks.
Right. Okay. There's some savings there, or you got bill pay. I mean, that type of thing. But I just look at it. You can't get to the equity without selling or refinancing. And the home's going to go up or down in value regardless of what you owe. It's not like, hey, I'm free and clear, my house is worth more. No, still worth the same amount. But now if you need money for emergency bills, now you're getting to an age, maybe you've got to worry about maybe more medical expenses. Maybe you need wheelchair. Maybe you need some money to retrofit the house. Maybe get rid of the stairs, make a ramp. I mean, just having some of that money there is better than I think equity you may not be able to get to. If your income drops and you can't qualify for a loan, or the loan you can qualify for is a way higher interest rate, you're better off just being your own bank and having the money in the bank. Now, here's one caveat with that. Don't have the money in your day-to-day checking account. It's too easy to transfer it. You do want to separate yourself a little bit from that money, maybe not in 401s or stuff that's really locked up, but you do want to have some systems in place. I'd love to sit down with you or a family member. I have a lot of kids that are kind of talking with their parents about what they do with this type of stuff. I'd love to show you how these loans work, or show you where maybe better places to put that money. They give you additional security, make it so you really don't have a mortgage payment because the money's there to pay for it, and you can have access to it if something does go wrong. So I'm a big believer, keep the mortgage and increase your savings.
All right, let's talk about reverse mortgages.
Okay.
This one here. My dad had a reverse mortgage condo and died. I'm his daughter and was living with him. If I'm giving the place back to the mortgage company, how long can I stay here?
Okay, so on a reverse mortgage, there's a certain time frame for when both borrowers, husband and spouse, or if there's two on the loan, so when both have passed away, there's a certain time frame that you either have to sell the property or refinance it. If you don't, that's when the mortgage company takes the property back. Now, in many cases, reverse mortgages are a very low loan to value, meaning that they only owe 50%, 60% of what the home is worth, or even less. So there's usually a lot of equity left over. In these cases, most of the time there are kids involved where they have 3 or 4 kids, or in this case, maybe only one. She could be awarded the home, so she has control of the asset. She would then want to start the process of refinancing the home. In most cases, it's 12 months in assisted living or a certain time frame once they've passed on. But you just can't take over a payment. There's no payment to be made. That clause of paying off the loan is now due. But there's usually a lot of equity in the home. There's usually ways to either get it sold or get it refinanced, where you just have to pay off the balance of that reverse mortgage. But once that one of those triggering things on the note happens, the time frame to start doing something happens. Now, let's say they owe more. Let's say for some reason they're in a market where they owe more than what the home is worth. There's mortgage insurance that kicks in that covers the balance on that loan. So they won't go after the heirs or the kids or anything like that if the balance happens to be more than what the home is worth. But that's incredibly rare. They loan only 30 to 50 to 60% of what it's worth, and it's based on their age. So if they've only had the loan for 2 or 3 years, the balance really hasn't gone up more than the appreciation on the home. So the short answer for her, I would start working on the refinance if she wants to keep it. If she just wants to sell it, pay off the balance, and keep the difference, you can do that as well. So I have a lot of people say, well, it's a reverse mortgage. Do they just get to keep the home? So they get to keep all the equity and all that? Absolutely not. They're owed a balance that's gone up since the loan started, but whatever's over that goes to the heirs or the estate or a charity or whatever the person set up to when that equity is cashed out would go to that person. So it is something where you got to start working on the loan or work on selling the property. That was a good one. Boy, you're finding some good questions here.
Thank you. I'm trying really hard. What if you own a home and you want to borrow money against your property, but you don't have a mortgage?
If you own the home, I guess he's saying it's free and clear. It's funny how the word mortgage can be intimidating to people. Oh, I need a home loan, but I don't want a mortgage. It's the same thing. A mortgage is just the word for a home loan. So if you want to pull out equity on a home, it's most likely called a refinance because you already own it. You're the owner of the property. You're not purchasing it. So the term is a refinance, but it's a mortgage. That's what a home loan is. So if it's free and clear and you want to pull some money out of your equity, whether it's a line of credit type of loan or just a new mortgage, as if kind of like the same as what you're buying it, but it's called a refinance. It's just kind of the terms that we use to describe what this is. But I've had a lot of people say, oh, you'll call up and say, I really need a home loan for this property, but I don't want a mortgage. Mortgages are bad. It's like, but that's what it is. It's just the term of what a loan is that's secured against real estate. It's called a mortgage. So part of the podcast and part of just educating people is realize it's not that scary of a thing. It's just the name of the loan. Just like a car loan, you wouldn't use a car loan to buy, a vacation package or something. I guess you could. You can pull the money out of a car loan, but a mortgage is simply a loan that's designed to do that. So if you don't want a mortgage, you're not getting a loan against a piece of property. But mortgages offer you better terms, better rates, longer repayment schedules, tax deductions. There's a lot more with the mortgage that you wouldn't get on any other Visa or other types of lines of credit secured against other things. So don't get scared of mortgages. They are a incredibly useful tool if you know how to use them. So get your mortgage and get your cash out for that guy, whatever his name was.
All right, this is actually a big one. This comes up a lot.
Ooh, I like it.
Why wouldn't a bank give me a mortgage if I am paying more in rent? And I see this has happened to me 100 times too.
Right. I've seen people that do that say, well, hey, I've been able to afford my rent payment. Why can't I just get a mortgage for the equivalent amount? And a lot of it has to do with, we know there's other expenses with the mortgage, and there's still other qualifications when it comes to actually loaning on a mortgage property than a rental. Because what happens if you don't make your rental payment? Well, you lose your rental. You're not losing a house. You're not going through foreclosure. You're not having these other things that happen to do with a house. A lot of times deferred maintenance kicks in if you're not taking care of the property. But it's still one of several things to get qualified. So if you have been making the rent payment, but you have a 500 credit score, no money in the bank, don't have a job, is that even though you somehow scrounged up enough money to make the payment, it's still something we have to go through qualifications to show you really can handle it. And I've seen a lot of times where people can afford that because they're getting help from other people, room rents and stuff like that would go away when they go to move into a house. So it is definitely a positive. Yes, we want to see that you don't go from a $1,000 rent payment to a $4,000 mortgage. That's called renter shock. So we actually want to see that. But just because you have somehow made a payment for $4,000, but you don't have the other boxes checked, doesn't mean that they'll still do the loan. So that's probably the shortest answer to a tricky question, but haven't stumped me yet. Come on.
Is it legal to give away or sell a home with an outstanding mortgage? What are the consequences if you do so?
Is it legal to give away or sell a home? Boy, those are completely different things. But here's the thing. If you have a house and has a mortgage, when you go to sell it, that has to be paid with the proceeds. So you can't have a $200,000 mortgage, have a $400,000 value, and just keep all $400,000. So what will happen is the title companies involved will say, okay, this is the owner, and he has a mortgage. Maybe he's got taxes owed. Maybe he's got whatever he's got owed that's tied to that property. Once that mortgage is paid, everything else does get sent to the seller or the trust or whoever owns the home. So it's something where I have people, the mortgage is tied to the home. They get paid first. If you sell the property, they get paid first. But once their balance is covered, you get what's left over. It's not something where the mortgage company just gets everything that's left over. Just like a car loan. So if you went to go sell your car, would you have to pay off the car loan? Of course. That's kind of common knowledge. Same thing with a home. If there's a loan or encumbrance or lien or judgment or something tied to the home, if you go to sell it, it needs to be cleared first. And the first gets cleared first, the second gets cleared second, third, fourth, whatever it is that's on the title report, those get paid. Then when the dust all settles and you paid commissions, you paid title fees, you paid appraisal, home warranties, whatever else is included in the contract, whatever's left over, that's what you actually get to keep. Now, is there some taxes on that? Depends on the ownership of the property. If it's been a rental property or if it's been a primary residence, there's different capital gains that could be on that. But whatever's left over, that's yours to keep. That is your money and will get sent as a wire or a check at the title company once the proceeds are all balanced. So no, you can't really give away a home and sell it without paying the mortgage. So the answer to that is no.
All right, this next one it looks like a soon-to-be ex-wife question.
Okay, soon. Okay.
You deal. I'm sure you deal with a lot of these divorce issues with mortgages all the time.
Yep.
How could my husband change a mortgage without my consent or signature?
They can't really change the mortgage unless that person's on the actual mortgage. So they can't. But if they're not on the property, if they're not actually a lien holder, they can add a lien to the property without acknowledging it. So there's a tricky difference between owning the home and being on the mortgage. Now, if you're on the mortgage, you're most likely on the property. If you're not on the mortgage, you might not be on the property. So you might want to check county records and just say, hey, who actually owns this property? If it's just in your husband's name, it might be an awkward conversation, especially if you're heading to divorce. You want to get yourself added to the title report. But to do that, the owners, whether there's one or plural, have to agree to adding you to the title. But when you're added to the title, you're not automatically added to the mortgage. The mortgage is a debt. The title is ownership. These are slightly different. Just the most common way to look at it is like on the car. Are you both on the car loan or just owner of the car? Same kind of thing can happen with mortgage. It's more complicated because it's a mortgage. It's a bigger asset, that type of thing. But it is something where if you're not on title and you're not even on the loan, then the husband can do kind of whatever. He's the owner and he qualified. He got a second mortgage. I see that happen a lot where all of a sudden they sell the property without notifying or they add a lien that they didn't know about. You just want to make sure if you're on the title. It's public record. You can go down to the county recorder's office in your state or your county and just say, who is the public owner of this home? Who's of public record of this property? If it's only in one person's name, you may want to have that conversation of getting yourself added. If it's in a trust or a living will, you may want to make sure you're at least part of the trust. So that'll be a little bit different if it's in that situation. So that's an interesting one because usually she finds out, hey, you went out and got this $50,000 line of credit. I didn't even know about it. Well, if you weren't on title, you wouldn't know about it. Just like we wouldn't disclose to anybody that's not involved in the transaction. So when we pull the title report, if it's in Mr. Joe Smith's name and Jill Smith's not on there, then she doesn't get notified. So you want to be at least on the title report.
Alrighty, tax deductions. I am paying the mortgage for my daughter. Where do I deduct the interest from taxes?
So it's a mortgage interest. They'll get a statement. She just can't claim it as well. So you have to talk to your CPA, get the 1098 that is from the lender showing how much was paid in interest. It'll be in her name. You can take that deduction as yours. She just can't take it as well. So you just want to make sure that she hasn't written it off. But there is a form that you can get, take it to your CPA, and it'll show how much you paid in mortgage interest. So it's a mortgage interest deduction. Your CPA should be able to help you with that. Even if it's not in your name, as long as it's not claimed by her, you would be able to claim it. Good questions.
I'm still looking. Hold on.
That was too quick of an answer, it looks like. So
I'm trying to weed through the ones that either mention Trump or Biden because I'm like, I don't know about that.
And we're just having a little fun here today. I just thought I'd kind of stump the mortgage guy. He's just trying to find a couple questions just off of the Quora and Reddit and just other places like that just have mortgage questions. But if you have any questions, please submit them in the comments below on my YouTube channel. I post this to Facebook. Check me out at Mortgage N3rd. And again, Nerd is N3rd, Mortgage N3rd on social media platforms. I try to put this out as much as possible. I love your comments, insights, questions. I love all that for the next shows.
Is it possible to be denied a mortgage loan after being pre-approved?
Absolutely. Absolutely. So
Why? Come on, man. I was pre-approved.
So the pre-approval is the application. So I have times where people say, well, I make $5,000 a month, but we get their pay stub and they took a bunch of time off. They make $4,200 a month. Well, now all of a sudden the debt ratio doesn't match or their jobs changes. So a lot of times going through a really accurate pre-approval helps us to make sure these things don't happen. But yes, you can get pre-approved. You can even get to the point where you've signed the loan documents and it still won't fund and record because maybe you lost your job. Maybe on Friday they'll do a final check, or you decided to go get a car loan, or you went down to the Boulevard Home Furnishings or whatever and got a new credit card for appliances after you signed on your loan, and now there's new inquiry, new debt. So it's not done until you are recorded, done, keys in hand. It can still get denied. So part of my job is to make sure we don't have that happen, walk through each one of these steps. But a pre-approval means that, okay, based on what you've given us, based on the application we have, you're approved. If anything changes on that, you can lose your approval. So sometimes it's not a whole lose approval, maybe just more documentation. We need an update on something or that kind of thing. But there's times where it goes like razor thin pre-approval and they change something and now they're not approved. So absolutely, until you get keys and you're recorded, it's not done.
What are the consequences of lying on a credit application for loans or mortgages?
It can be as much as mortgage fraud. It can be up to $1 million and 30 years in prison. Now, that's pretty crazy. You'd have to do a lot of mortgage fraud to get that max penalty, but it is fraudulent. Now, best of your knowledge, if you don't know or you're unsure, that's a part of my job on the application is to get to the best of our knowledge. And as we get information to verify, we go back and adjust the application. So you can make adjustments, you can make changes all the way to when you sign the final and we actually go to close and fund. But if you know that you're signing an application at the very end that isn't right, then that is where you are committing mortgage fraud. You're basically certifying that, yes, I've worked at this company. Yes, I've made this income. Yes, I don't have any other debts. I don't have child support. I don't have these other things. If you're knowingly doing it, that's where you are committing mortgage fraud. That's the answer to that. So just don't lie. And you're far better off to just open communication with your loan officer. Just talk to them about sometimes people will hold information back because they don't want it to screw up their file. Where a lot of times we're your advocate. We want to go through and figure out a way to get around it. It's much better being transparent with your loan officer so you can find a solution to get around the issue. There's a guideline for everything. So knowing what we're working with will help us to make sure you're doing the right loan and not doing something where you're putting yourself at risk for mortgage fraud.
All right, one really quick one here.
Yeah, quick one.
What will happen when my mother-in-law passes away if my husband and her are on the mortgage and deed together?
Depends on the state, but in most cases, they're on the title, so they already own the property. the loan would not be called due necessarily if there's not payments being made. So really, it would be just status quo. Just keep making the payment on the property. The lender's not going to foreclose on something if they keep making their payment, but it may be something where you'll have to get a copy of the divorce decree, take it down to the recorder's office and remove her name from the title, and then just keep making the mortgage payment. So it's not, unless it's a reverse mortgage or certain loans that do require that loan gets paid off now, in most cases, it's just continue as normal. As long as the payments are made, the mortgage company's not going to automatically just start foreclosing on the property. We're not in the business of foreclosure. We don't want to foreclose. We want our payments. So as long as the payments keep being made, you'll be totally fine. But hey, I thought it was kind of fun. We just wanted to throw.
Thank you.
Yeah, thanks, Freddie Mac, our producer here, for just trying to stump me, and he just didn't. So check out RyanBolton.com, check out Mortgage Nerd, and we'll see you on the next one.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear the number 2, closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender, NMLS number 299717. This has been a production from a podcast studio.